Hi, I'm James Fang, CFA content developer at UWorld, and today we will continue on Alpha Inc. with the decomposition of its asset base and capital structure. So let's look at Alpha Inc.'s asset base. So this is a common size balance sheet. We're just looking at the assets right now, which is the left side of the balance sheet. So the key thing to note at a high level is that there has been a shift in mix between percentage of current assets and non-current assets. We could see that the company has been investing more in long-term assets. So you could see over here about 70% and 30%. This has been increasing, this has been decreasing. What's driving the increased composition of long-term assets? It's goodwill and intangible assets. This means that the company has been making a lot of acquisitions because goodwill can only arise from acquisitions. This is also somewhat of a concern because goodwill is subject to future impairment losses. If we look at the current assets, we will see that the main change is a drop in marketable securities. So marketable securities are very liquid. You can think of CDs, you can think of treasuries. Now, you would think that a lot of times if a company increased its marketable securities, they probably just sold that for cash. You would expect to see an increase in cash. Over here, we see somewhat of an increase in the percentage of cash holdings, but not enough to offset that decrease in marketable securities. So cash had to have been used somewhere else. My suspicion is that it's primarily been used for M&A and other long-term assets. So as another indication of acquisitions, we could see that a lot of the investing cash flow on the cash flow statements has gone out the window. So that's towards M&A. And you could also see that there has been more use of the cash being paid for interest, which again, we saw the company sell a lot of its marketable securities. Let's look at capital structure analysis. So we're mainly looking at sources of long-term capital over here. We're mainly looking at long-term debt and shareholders' equity, which it's calculated from these numbers below, provided from above. We can see that the company has increased its concentration of shareholders' equity from 72 all the way to 78%, while reducing its financial leverage. So this could be a sign that it's a good sign that the company's deleveraging its use of debt. And then when we look at pension obligations are technically, they're not considered financial obligations. These are post-retirement obligations owed to its employees. It's been staying at a fairly consistent level. Not something I'm too concerned about over here. The overall take from this picture is that the company's been delevering, which could be a good sign. So far we've looked at more of the long-term capital and the long-term assets. Let's look at the company's liquidity position through working capital management. So liquidity measures a company's ability to satisfy its current obligations. So we'll look at several ratios from above here. Then we will look at the cash conversion cycle down here. So if we look at the current ratio and the quick ratio, so current